Ford shares, take a look, dropping after hours, close to down 5% right now. The automaker warning about higher than expected costs for Q3 and supply chain challenges that will leave thousands of vehicles unfinished. They still need the parts. Phil LeBeau here to take us inside this warning, Phil. So they're reiterating guidance, right? But warning of some issues.
Full year guidance. Right, Sarah. They're reiterating full year guidance. But in the third quarter, we're seeing the stress in the supply chain coming and hurting Ford in terms of what the company expects to make in the third quarter. The company is issuing new guidance. It is for an adjusted EBIT of 1.4 to 1.7 billion. Now, they never gave previous guidance, but the analysts, the consensus, according to FactSet, was for Ford to report in the third quarter a profit of 2.98 billion. So this is coming in far below what analysts were expecting. They're blaming this on a $1 billion increase in supplier costs, and this is basically the supply chain overall. And there are 40 to 45,000 vehicles that they have built, but they have not delivered. They would deliver these to the dealers who bought them if they had the parts. They expect to deliver them in the fourth quarter. So as you take a look at shares of Ford, the full-year profit guide remains in place. The company expects to deliver these vehicles. They expect to be able to absorb this increase in supplier costs and report a profit of 11.5 to 12.5 billion for the full year. So they're not changing their full-year guidance, but they are saying, look, right now the supply chain is hurting the company. And this is not unusual. We've heard this from other automakers. We've heard it in aerospace, manufacturing across the board. Bottom line is this. They are feeling the pinch at Ford. And what's interesting here, Sarah, I've talked to people at Ford. These are not chip-related supplier problems. I can't say that enough. This is not because of having a shortage of chips. It's a shortage of parts across the board. And that speaks to the stress for Tier 1 and Tier 2 suppliers in the auto industry, which is not new. This has been known for several months. I talked to somebody just a few minutes ago when I called him up and I said, Ford's warning. What do you think about this? He said, who isn't warning? The supply chain it's breaking down in certain areas, not across the board,
it was getting better,
but in certain areas. And no, it's not. It's not getting better. It's getting better in terms of chip supply, but in terms of the costs and the ability for all suppliers to ramp up their production to the level, whether it's Ford or GM or anybody, it's tough for these smaller suppliers, and there are also some Tier 1s. They cannot increase. They don't have the manpower. The costs are going up. And in many cases, they cannot meet the demand for a variety of reasons. And again, it's not across the board, but all you need are a few here and there. And that's where you see the impact.
Yeah, $1 billion cost. Phil LeBeau, thank you very much. Good color. Let's trade this now. So, Tim, you own Ford. It's already 42% off the highs.
I own Ford. I own GM. I will say, if you look at Ford on a 1 year, it's actually outperformed the S&P by almost 30% through good times and bad. We know that they had a great run towards the end of last year, but those numbers, if you reaffirm at 12 billion in EBIT, you're at 4.2 times where the market cap is right now on 22 numbers. I get back to the case that this is a company that's run differently than it has been. They're going to be free cash flow generative. They raised their dividend in the second quarter numbers. We had heard also at the end of the second quarter about 35,000 incomplete, unfinished vehicles. So this doesn't really surprise me. And I guess the dynamic is we see that they have pricing power. They're the clear number 2 in EV. And at this valuation, I can sleep at night. I know it's not going to be easy here. But again, I think these guys are running the company very differently than they have.
Grasso?
Yeah, first of all, they all bounced off their June lows, all the car companies. If we play a game called Would You Rather, I would rather be in GM. I think they have a little more momentum on their side, Sarah, as far as stock price. But both names seem to be in a short-term declining trend line. And I mean really short-term, because they both just bounced, but they failed off their recent highs off that June low. So I'd probably stay clear until some of the supply chain glut or not in glut resolves itself. I'd stay out of that space and go with the EVs. Tesla seems to be outperforming right now.